or cause to be paid any fees from the scheme that have not been provided for in the trust deed. Underline the word not, that's pretty obvious. And the manager should not pay or cause to be paid any marketing or promotion expenses from the scheme. Right? Take a note on that one. This one not so obvious. Now, should not pay or cause to be paid any marketing or promotion expenses from the scheme. Such expenses include those for advertisement in media, mailers, fact sheets, but excludes those for the preparation, printing, lodgement, and distribution of prospectus, and profile statements and product highlight sheets. Okay, so those are disbursements in running of the scheme, right? Preparation, printing, lodgement, and distribution of prospectuses, profile statements, or product highlight sheets. Okay, the other kinds of promotion, the marketing material, should not be paid out from the scheme. Now then, importantly, the paragraph F in terms of performance fees. Now, for performance fees that are payable should meet the following requirements under A1 to 3. All right. First, calculation of performance fee payable should be equitable to all participants. It must not be biased in any way. So the key word there is equitable. Right? It must be fair. And the performance fees should be calculated and paid after consideration of all other relevant payments. Right? That should be last. The period over which performance fees accrues and the frequency with which it crystallizes should be appropriate. Crystallizes meaning it comes about. You realize it. You get it, right? Crystallization of performance fees should be no more frequent than once a year. Right? So in other words, this performance fee should crystallize, should come about when crystallization, right, should be no more frequent than once a year. So that's in terms of the calculation of the performance fees and the period over which performance fee accrues and the frequency in which it crystallizes over time. Now then, following that, you have the calculation method. Here, the code gives two methods of calculation. One is income in terms of a fulcrum fee or a high watermark arrangement. Okay, so those are the two methods, either or, in terms of the method of calculation. And under paragraph 5 below there, where 3.6A4A applies, right? You look at 3.6A, 4A, that's a fulcrum fee, right? 3.6A, 4A, right? That's a fulcrum fee. The fulcrum fee should increase or decrease proportionally with investment performance of the scheme as compared to the specified benchmark, and be limited to between 0 and 200% of the base fee. Right? So that is a bit technical there in terms of how you calculate the performance fee in terms of based on the fulcrum fee method. Right? Guidance is given to you below. Fulcrum fee as a percentage of the NAV per unit of the scheme should be applied in a symmetric manner. Underline that word, symmetric manner. Alright, for example, where the base fee is 1.5%, the fulcrum fee should range from 0 to 3%. Alright, so that's in terms of paragraph 5. Alright, now paragraph 6 there, where chapter 3.6A 4B applies. What does that mean? So you can look at 3.6A 4B, alright, that is the high watermark arrangement. So you're using the high watermark arrangement. The high watermark should be reset to the NAV of the scheme only when the NAV of the scheme reaches a new historical height at the end of each performance period. Right? That's in terms of 6. All right, and 7, if you quickly look below, the performance fee should be calculated on an appropriate benchmark, such as an index, a defined positive rate of return which may be fixed or variable, or any other factor given the scheme's investment objectives and consistently applied. So that's in relation to the high water arrangement method. I hope you are clear on that one. So under the fulcrum fee, the code gives you some guidance as to how to calculate it. And under high water mark arrangement, similarly, the guidance is provided for under paragraph 6. Right? Now then B says that the manager should consult the MAS if he intends to use the performance fee method other than those specified under 3.6A4. All right, if you go back to 3.6A4, they said it should be calculated based on the fulcrum fee or the high water mark arrangement. All right, so if this manager decides not to use these two methods, all right, other than the fulcrum fee and the high water mark arrangement under 3.6A4, all right, then you need to consult the authority, right, the MAS, and seek their approval. All right? So that's in terms of how the performance fees are calculated. Now, then you move down to C, disclosure requirements, right? Similarly, as before, all the disclosure requirements must be upfront, clear, simple, and the standards must be met. Right? But in addition to that, since this is a collective investment scheme, in terms of where performance fees are payable, all right, the prospectus should contain disclosures on one, in the fact that a performance fee is payable and to whom it is payable. All right, so the payee must be identified clearly, the participant. In fact, if applicable, their performance fee can be levied even if the return of the scheme is negative. Right, these are all disclosure requirements. The maximum amount or percentage of the scheme's NAV that a performance fee might represent in an annual accounting period. Illustrations such as numerical examples of how the performance fee is calculated. And 5, whether the scheme achieves equalization of performance fee, or where it does not achieve equalization of performance fees, to state the fact and how the absence of equalization may affect the amount of performance fee borne by the participant. Okay? So that is the segment on performance fees, right? So end of the day, the participant has to bear the performance fee, so therefore it must be clearly set out. Okay? So that is paragraph 3.6. All right, now moving across the page there, paragraph 3.7 gives an illustration in terms of the fulcrum fee arrangement. Now just pause for a little while there for you to take a look at the example there. All right, so the XYZ Global Equity Fund adopts a fulcrum fee arrangement for calculating its performance fee. The benchmark that's used is MSCI World Index Return, and the scheme charges a base fee of 2% and a performance fee of 10%. All right, so assume that the returns of the fund and the benchmark, that's the index there, over the next 4 years follow the chart below. So they give you some calculation. In terms of the global fund, the XYZ Global Equity Fund, and the MSCI World Index, and then how they track. All right? And then the calculations of both the management and the performance fees are shown in the table below. Year 1, 2, 3, 4, the base fee, the performance fee at the second row, and the fulcrum fee on the third row. Okay? So that's how the fulcrum fee arrangement looks like. Like I said earlier from the start, this chapter is pretty technical, so take a bit more time on it. Now then, if you look at the illustration 2, that gives you the illustration on the high water mark arrangement. All right. Similarly, they're using the same example. XYZ Global Equity Fund adopts a high water mark arrangement for calculating its performance fees. And they use the benchmark as MSCI World Index again for this example. And its hurdle rate is the return on the MSCI World Index. All right, the scheme charges a management of 2% and a performance fee of 10%, and that's how they calculate. All right, so I just pause there for a little while longer. So take a good look at how the fulcrum fee arrangement and the high water mark arrangement looks, how these two methods look like. Okay. All right. Now let's move on to paragraph 4. Here it talks about the naming of the scheme, right? Naming of the CIS, how you hold the CIS, whether it's a XYZ Global Equity Fund or Nippon Fund or German Fund or whatever fund you would like to call it. Right? So the scheme's name should be appropriate, not be undesirable, and not misleading. Right? So it must accurately describes and depicts the scheme. In assessing whether the name is undesirable or misleading, the MAS will consider the following factors. All right, here it gives you B1 to 6, all right, in relation to how the authority will not approve of the naming of a scheme. Right? Example, it's substantially similar to the name of another scheme. All right, so this is not acceptable. Implies that the scheme has merits which are not or might not be justified. Implies that the manager has particular qualities, right? The manager is a super manager, right? Which may not be justified. It is inconsistent with the scheme's investment approach, investment objective, investment focus. All right. So your naming must be in line with the objective, the approach, and the focus. Implies that the scheme is not a collective investment scheme. For example, describing the scheme as a plan or an account. Right? So, and then might mislead prospective participants into thinking that persons other than the manager are responsible for the scheme. All right, some of them may name it in such a way that it gives the impression, a false impression that a bank, or a finance company or an insurance company is responsible. Now, of course, for the avoidance of doubt, the use of acronyms in names is permissible, provided they are appropriate. Right? So instead of saying a Japan fund, you can say it's a Nippon fund, some acronym, and whatever acronym that it may be chosen to represent it. Now to give you some guidance following that one. Okay. You look down the lines. The use acronyms which will reflect an index provider, a credit rating agency, or even a geographical region may be acceptable. All right. For example, MSCI, S&P, BRIC, if it is consistent with the scheme's investment objectives or approach. All right. But for good order, say generally in the prospectus and whatever material, it's always good to spell out the thing in full and then put inverted commas, or put in within brackets and inverted commas the acronym, and that will save a lot of argument or dispute moving forward. Right, then guidance 2, in assessing whether it's appropriate to include a term fund of funds in the name of a scheme, the authority will consider acceptable if the scheme's primary investment approach is to invest all or substantially all of its assets into 5 underlying or more underlying funds via a fund of funds investment approach. All right, so there's a guidance given to you. Even to use fund of funds, it should be 5 or more underlying funds via the fund of funds approach. So in order that it's not misleading, right? So if the term fund of funds is being used in the name of a scheme, then it should be more than 5 or more, right? 5 is okay, but more should be better. Now then there's a key point there, guidance 3, where the name includes or uses the term as capital guaranteed. Now this is a bit sensitive, right? Whether it's capital guaranteed or not. In the past there were issues regarding this, where people use the word in a careless way and gives rise to legal fights and disputes in court. which belongs to any category of schemes as prescribed in the appendices. The scheme should comply with those relevant guidelines. Right? Conversely, if a scheme's name uses a term which is prescribed in the appendices but does not comply with those guidelines, the name would be deemed inappropriate. Right? Just be careful when you're using capital guaranteed or capital assured or capital protect. This further down, we can see that the name of a scheme's class of unit should not be disavowed misleading. The use of the following terms or any other derivative or form of such terms in a scheme's name is prohibited. Capital protected, principal protected. All right. So there's always differences in interpreting the word protected. So is capital protected or principal protected means that it is principal guaranteed. All right. That means if anything happens, I can get my principal back. So what do the words capital protected or the words principal protected mean? Right? So quite vague there. So therefore, these words are prohibited. Right? If it's capital guaranteed, if it's a guaranteed, capital guaranteed say so. Principal guaranteed say so. The word guarantee is much stronger and clearer, right, rather than protected. Right? Okay. So then, of course, there are some prohibited activities in terms of the under the code of investment schemes. The scheme should not engage in direct lending of monies. That's one. 2, granting of guarantees, underwriting, or short selling. Except where this arises from financial derivatives which are invested in accordance with sections 4 and 5 of the appendix. All right, that's in terms of short selling. All right, so the key prohibitions are no direct lending of money, no granting of guarantees, no underwriting, or short selling, except under the provisions given under sections 4 and 5 of appendix 1. Okay. Then limited liability, right? The liability of participants, this is important, should be limited to the investment in the scheme. All right. So if a participant put in, say, 50,000, 100,000, that should be it. Right? You cannot ask him to pay more than what he has committed in investing in the scheme. For this purpose, the trust deed of the scheme should contain a clear provision limiting the liability of participants to their investments in the scheme. Right? So this is limited liability of the participant. Then D talks about core requirements. Right? The core investment guidelines and borrowing limits should be adhered to as given in appendices. Now, where the scheme contains a novel or new structure, risk or investment policy, then the manager must consult the MAS prior to its application for authorization. So that those are the core requirements. Then E talks about advertisements. I do not wish to go further on that one. I believe you already know. Advertisements must be clear. It must be compliant with the code of best practices in advertising collective investment schemes and investment-linked life insurance policies. All right, these have been issued by the Investment Management Association of Singapore and the Life Insurance Association in Singapore. Now, these are the associations and organizations that we talked about earlier in chapter 1, I believe, yeah. So the Investment Management Association of Singapore also gives some guidelines, and similarly the Life Insurance Association also the same in terms of the investment-linked policies. All right. So advertisements must not be misleading. It must be clear. It must be informative, right? So that the prospective customers able to understand the products and services that are being offered, and they can make an informed decision whether to listen to the advice or to buy the products, as the case may be. All right. So the disclosure requirements are clear. So the managers have to comply with that. Now, very quickly, paragraph 5 talks about accounts and reports. Right? And where half-yearly financial statements and audited statements are required, semi-annual report and annual report also are required, and this must be done in a manner prescribed by the Institute of Singapore Chartered Accountants in the Statement of Recommended Accounting Practice 7, Reporting Framework for Unit Trusts. Right? Now, of course, this is subject to amendments and over time in terms of the financial management practices from time to time. All right, so that is the purpose, the standard that's required under accounts and reports. All right, of course, 5.1.2 there talks about semi-annual report or annual report need not be prepared or audited where applicable and sent when they cover a period ending 3 months or less from the start of the initial launch period of a scheme. All right, they give some breathing space there. However, the first semi-annual and annual reports prepared, audited, and obliged and sent to participants should cover a period from the start of the initial launch period. All right, so, and then, or B, a period ending before the termination or maturity date of a scheme if they are due to be sent to participants within 1 month prior to the termination or maturity date. These are all very practical things, right? So, yeah, and then guidance, the under 5A, 5.1.2 below, it gives a guidance as how the accounts and the reports are to be done, right? How they are to be prepared, audited where applicable, and sent over to the participants. Okay. Now, B gives you a bit more in terms of reports. The semi-annual report and the annual report based on the scheme's financial year should contain the following where relevant. A, investment at market value and as a percentage of the scheme's net NAV, net asset value, as at the end of the period under review, classified by country, industry, asset class, and credit rating. Right? That is how the semi-annual report and the annual report are to cover. Right? And B, the top 10 holdings are covered at market value and as a percentage of the scheme's NAV as at the end of the period under review and a year ago. All right? And C talks about exposure to financial derivatives under 1, 2, and 3. All right? And then you cast your eye down the page, D, E, F, G, H, I, J, K, L, M, and N. Right? So there are a lot of details for you to look at in terms of the reports. Right? So the contents of the report, right? What go into the report, right, are given to you from paragraph A, 5.2A, all the way to 5.2N. Okay? Right, so there are a lot of information there. You need to take your time to digest it in terms of the contents, right, in terms of what go into the report. All right. Now let's look at paragraph 6. Paragraph 6 talks about dealing and valuation. Now 6A talks about the manager should deal in units in a scheme in accordance with the trust deed and the prospectus. Right? If you look at the trust deed and the prospectus, it should be stated clearly in terms of the frequency of dealing. And in any event, at least one dealing day a month. All right? So that is the dealing part under 6A, 6.1. Right? Under in the box there. Now under 6B, suspension of dealings. it says that the manager may suspend dealings in units only underlined in exceptional circumstances. Okay? After having determined that a suspension is in the best interest of participants. All right? Underline the word best interest. All right? And then it gives you some guidance there. Difficulties in realizing scheme assets or temporary shortfalls in liquidity may not on their own be sufficient justification for suspension. Right, I just pause there for a while. Right? The guidance is clear. All right? If temporary shortfall in liquidity, some difficulty in realizing the scheme's assets, well, these two factors may not on their own be sufficient justification for suspension. Right? It must be something more exceptional than that. Now, if there's any suspension, the manager should immediately notify participants and the MAS if the dealing in units is suspended, stating clearly the reasons for the suspension. Right, guidance given, the manager is considered to have notified the participants if a notice on the suspension is sent to the distributors of the scheme for dissemination to the participants. The suspension should cease as soon as practicable when the exceptional circumstances cease to exist, right? So again, the meaning of exceptional circumstances, right? And in any event, within 21 days of the commencement of suspension. The period of suspension may be extended if the manager satisfies the trustee that it is in the best interest of participants for dealing in units to remain suspended. And such suspension should be subject to weekly review by the trustee. All right? So there's a lot of things there too. If there is going to be any suspension of dealings in the CIS. Right? Then paragraph C talks about resumption of dealings. The trustee should notice the authority when the manager has resumed the dealing in units. In addition, the manager should notify participants when the dealing in units has resumed. Right? So similarly, the manager is considered to have notified the participants if a notice on the resumption is sent to the distributors of the scheme for dissemination to the participants. Right? So that's in relation to dealing and valuation. Now, more specifically, we look at valuation. This is technical as well. Right? How do we evaluate unit trust in a scheme? Right? The manager should issue, redeem, or repurchase units in a scheme at a price arrived at by dividing the scheme's NAV by the number of units outstanding. The price of the units may be adjusted by adding or subtracting, as the case may be, fees and charges in compliance with the scheme's prospectus or trustee. Where closed-end scheme is listed on an approved or overseas exchange, the manager should issue, redeem, or repurchase units in a closed-end scheme in accordance with applicable listing requirements of the approved or overseas exchange. Right? Then B talks about the manager should ensure that the scheme's NAV is calculated on a consistent basis and in accordance with the manner prescribed by the Institute of Singapore Chartered Accountants in the statement of recommended accounting practice number 7, right? Reporting framework for unit trust in particular. Right? Then C talks about the maturity of the capital guaranteed schemes, which complies with Appendix 4. Right? And capital guaranteed funds, the unit should be redeemed at a price equal to or higher of the guaranteed amount. And the scheme's NAV divided by the number of units outstanding. Right? So that is in relation to